Yeah.
So we're going to go to the next article today. We have 17% of homeowners with mortgages have an interest rate of at least 6%, the highest share in nearly a decade from Redfin. Now, I want to make sure right out at the top here we kind of qualify this. Yeah. The last decade would be since 2015. And in that last decade, mortgage rates were relatively low.
Yeah, they were in the 4 or 5.
So the kind of like the shock title of the highest in nearly a decade is not really a shock because we're not talking highs of like mortgage rates in 10s and 12s. Yeah. It was, okay, they hit 8 in October of 2023, which was terrible.
Wow.
Right? But as you're going to see here in some of these charts we'll put up when we get to them, is the shift in the landscape of how people are holding their mortgage debt was dramatically changed because of 2020, which we know. But it is really slow to make new changes. It was really fast to make those changes during the shutdown, and now it's really slow to look any different at all.
Yeah.
So we have 17.2% of homeowners with mortgages have an interest rate greater or equal to 6, which means we have 82% that have an interest rate below 6.
Yeah.
And I think the reason of this shift is what we've been talking about, which is people, they've just needed to refinance. They've had to take cash out of their house, or some people had to move and go out of a high-cost area to a low-cost area. And then some of the things they reference in here, too, are just the reasons why people move. And I want to spend a little time on that one. But what's your initial response and reaction to kind of just learning this?
Yeah, no, my initial is like, I understand that. And, of course, we've been, in the last over 36 months, we've been in a higher rate environment. I mean, it more than doubled when you're looking at in 2021, the average interest rate was like 2.6, so it's more than doubled now. And we've been there for over 36 months.
Yeah.
So to see this is not surprising, 17%. And yes, it does show here that that's nearly 5% points from 12.3% in the third quarter of 2023. Yeah, it's increased, of course, because people, like you mentioned, that was my notes right here. People need to cash out. People understand that if my rate's going to be 6 or 7 or 8%, I might as well just cash out right now versus paying a credit card that I'm paying minimum payments at 15, 23, 32%. And here's the thing what people do not realize, Andy, on a credit card, nobody reads the fine print. But if your credit limit is $5,000 and you go above $1, you voided your contract. You're paying now that higher rate, and it says that higher rate can go anywhere from 33 to like 40%. So people don't realize that. They just say, it's okay. I'm already shopping. I don't want to be embarrassed. Just push it through, right? You're at the cashiers. Just push it through, and then I'll just pay it. Little did you know, you just put yourself in a higher interest rate environment. Read the fine print.
Yeah, that's a hard one. And, I'll cautiously say this, like we can help people with that, not on the credit side, but on the lending side. And we just had a case study recently that came up because Brian had talked about how he had helped a client save $2,722. So as part of our new kind of case study series coming out this year, Brian just kind of got us started with that. So if you want to watch that video, you can click the card up in this part of the video. You can watch that right there. But this is happening. And I think that the chart you're going to see on the screen right now, this is the evidence of that. It's kind of like a top of the fold and below the fold. Let me explain real quick. So on the very right-hand side of the chart, you see that blue bar. That represents 3.99%. Yeah. Everything below that is everyone who has a loan below 3.99%. And I want you to skip that kind of upper third section and go to the right at the top. That red bar represents people who have loans at 6% or higher. And you look at it's representative. It's more representative over the last 4 years, especially in this last 36 months that Memo's talking about. You can look at that red bar has grown bigger and become a higher percentage of rates above 6% as we've seen rates go up.
Yeah.
So you're like, duh, that makes sense. The data is correlating what you're seeing in the market. But again, unless you needed to do that, you didn't have to do that. So, this is to me kind of that like, it actually happens to be a red bar. So it's kind of like that little flashing red light. It's like, hey, warning, the market is up here, and people are having to take that rate for whatever that reason is.
No, it is. It's crazy. I mean, we already know credit card consumer debt is over $3 trillion.
Wait, what? 3? I thought it was 1.2 trillion.
1.2. I'm sorry. Yeah, I went up. It was 1.6 trillion right now. The last that I saw, it went up to 1.6. I'm like 3. No.
I want to know what 3 trillion. 3 trillion's in your head for something.
Yeah, no. It was a brain fart. But yeah, it's the highest debt we've been. Wow. It's like people are just we're living off our credit cards.
Yeah.
We're paying off debts with our credit cards. Banks,
debt with debt.
debt with debt. You know, we're borrowing from Peter to pay Paul, but the Peter and Paul are just not working out. They're high interest rates
both
for
robbers.
both, right? And it's not that they're robbers. It's just that's the only means that most people have right now because
I know.
we get so caught up with our current interest rate so low. I don't want to give that up.
Yeah.
You know, it's just frightening to see these graphs, and that is everything. One thing you've taught us is go by data. You know, just don't talk. Like, go with data that's actually supported.
And it's telling you something. And I mean, you know, I know we're trying to be. I'm trying to be lighthearted about this, but like, look, people they come to us and they're having a serious problem because if they don't cure this like credit issue or debt issue, the house then becomes the thing that gets threatened.
Absolutely.
Because if you start becoming late on payments, then you can't qualify.
Yeah.
And if you start making late mortgage payments, well, now you're really sinking the ship. And then now what do you do? Like if you can't get qualified to do a refinance or a HELOC to pay off the debt because you can't afford to serve the debt, and then your house now becomes late, it's like quickly becoming this avalanche of problem, and then you're
you know, funny you mentioned that. I had a client that gave me a call last night, very dear, like super good guy. But in June we were trying to do a line of credit, but when your credit score is at a certain tier, you just won't qualify. Your credit's not there. At this point in time, he also didn't have a job, but he felt like everything just came upon him. You know, I have my mortgage, I have all my credit cards. How do I go about this? Mind you, this person had, 700 plus credit scores. He was excellent. And to see that I'm just in need for $30,000, because I don't have a job, that's becoming difficult. My advice at that time was call your creditor. Call the credit cards. Tell them you can't pay right now. Avoid having a 30-day late on your credit cards. Some work with you. Some actually put in insurance and they put that on hold. They'll make it seem like it's closed on your credit report, which is okay. But some people think that, oh man, my credit's going to get even ruined even more so because now it's closed. Not realizing that a 30-day or a 60-day, 90-day would have a way
detrimental impact
on your credit. So fast forward, we couldn't do that line of credit. You don't have a job. You can't prove repayment, and everything that has to do with loans, it's repayment. It just didn't happen. So fast forward, he ended up getting, yesterday I had a conversation with him. He had a job. He's got a job. Things are looking better for him, but his credit now, he's in the low 500s.
Oh man.
Hey, I need a line of credit. I just need to pay off $22,000. I just got money back from my taxes. I'm going to pay that. How do I pay my credit cards in order for it to impact my credit score the best, and so that I can qualify for a line of credit now that my credit's low? So first rule of, my advice is first pay them down on your credit cards below the 50%, just $1 below 50% of your high credit limit. That's right there a good start. Don't just go and pay one full off. Try to get them so that way you can have an even playing field with all your credit cards, right? So that's what he's doing. And then he mentioned, I have a home that I bought in 2022 in Vegas, and so I bought that at 230. I had to put 25% down to qualify. At that time, I didn't mention this, but back when we spoke originally, I didn't have a tenant in there. So I had to support that as well. Because I didn't have a tenant in there. I had to go through the eviction process, etc. So I'm like, oh my God. So at that point in time, I told him, you have the solution right there. What's the value of your property now? He said like 260, 280, and I only owe like 165, So you already know where I went with this. I say, you're not going to have capital gains because you bought it for 235. You're going to have realtor fees and all that stuff. So basically what you're doing is you're getting back that 25,000 that you originally put into it. And now that allows you to pay off all your debt.
Yeah.
So that was my approach is never get so freaking caught up with your investment.
Did he put
Learn to depart.
Did he put 25,000 or 25%? 25%. Well, yeah. So okay, that's a big, that's because you said his mortgage was only like 160.
Yeah, it's only 160, 65. So yeah,
minus costs and fees and closing costs. He's going to walk with what, maybe 70 or 80?
I don't probably. Yeah. I'm thinking less than that, but still, it's enough for him to pay that off. And then you don't have to worry about a tenant. You kind of refocus.
And he has cash right away.
Exactly. You focus on getting your credit where it needs to be. Don't acquire new debt. And just don't get freaking, emotionally attached to your investments is what it is.
I want to make sure that this doesn't like fly past people, because you're telling this story about the client that called you, but I want everyone to know, like, yes, we are the mortgage heroes, and yes, our job is to do mortgages, but sometimes the advice is you need to find a realtor and sell your house.
Yeah.
Like that is sometimes the only thing that can happen, and it's probably in some cases the only thing that should happen.
Yeah. And what it was is I go, pat yourself in the back. You have an investment.
Right.
Right now, that'll get you out of it, get your credit where you need to be.
Yeah.
And, as we move through things, it's like now as investors, like, remember, we can do different type of loans with just 10% down, as an investor. So
I think that's super awesome. And I would not be surprised if people who are in this same benchmark of the higher interest rates are going to find themselves in the same situation.
Yeah,
so.
Talk to your local realtor, your local lender, and then just see what's your best, outlet on this in order to put yourself financially in a better position.
Yeah. For those of you that really want to nerd out on this specific article, you can check the description box below. You'll see it's the second article there, the one from Redfin. You can check out all the other graphs on that.